The Bull Case, the emerging preeminent streamer of the Vicuña district and the Fruta del Norte corridor. Incorporated in July 2025 and spun out from NGX Minerals in late 2025, LunR was positioned as the primary vehicle for the Lundin Group to consolidate and monetize its high-grade royalty interests in South America. The company's strategic trajectory was fundamentally accelerated in February 2026 through the announcement of a $670 million acquisition of a life-of-mine silver stream on the Fruta del Norte (FDN) mine in Ecuador. The October 2025 spinout from NGX Minerals provided LunR with its foundational assets, a 1% net smelter return royalty on the Lunahuasi project in Argentina and a 1.38% net smelter royalty on the Los Helados project in Chile. This initial portfolio offered investors a pure-play entry into the Vicuña district, a region that has recently become the focus of global base metal exploration following the massive discoveries at Filo del Sol and Josemaria. The cornerstone asset, Fruta del Norte Silver Stream. The definitive agreement signed on April 2, 2026 to acquire a life-of-mine (LOM) silver stream on the Fruta del Norte (FDN) mine in Ecuador for $670 million is the most significant milestone in LunR's short history. FDN, operated by Lundin Gold Inc., TSX-LUG, is widely considered one of the highest-grade, lowest-cost gold mines in production globally. The mine poured its first gold in November 2019 and reached commercial production in February 2020, consistently delivering operational excellence since inception. Transaction structure and consideration. The transaction is structured as a silver for equity exchange, with LunR issuing 50,505,051 common shares to Lundin Gold. A critical component of the deal is that Lundin Gold intends to distribute these LunR shares to its own shareholders as a dividend-in-kind as soon as practicable after closing in Q2 2026. This ensures that Lundin Gold does not retain a controlling interest in LunR while simultaneously broadening LunR's institutional and retail shareholder base. The stream is designed with a tiered reduction schedule, providing LunR with aggressive near-term cash flow while ensuring the long-term sustainability of the asset for the operator. The effective date of the stream is March 1, 2026, meaning LunR will benefit from deliveries occurring shortly after the formal closing. During the first drop-down phase, LunR will purchase 100% of payable silver until 12.2 million ounces are confirmed, paying 10% of the spot price to the operator. In the second phase, LunR will purchase 50% of payable silver for the next 7.8 million ounces at 20% of the spot price. For the remaining life of the mine, a tail stream of 7.5% of payable silver will be maintained at 30% of the spot price. The 2026 production guidance for FDN includes 500,000 to 600,000 ounces of payable silver, placing LunR in a position to generate significant top-line revenue immediately upon closing. With gold prices surging to record highs in early 2026, the silver byproduct, often overlooked by pure-play gold miners, represents a high-margin cash generator for a streamer like LunR.
The security of LunR's cash flow is underpinned by FDN's operational performance. In Q1 2026, the mine produced 119,742 ounces of gold from 496,798 tons of ore. The mill achieved a record average throughput of 5,520 tons per day at an average grade of 8.4 grams per T gold, with recovery rates reaching 89.2%. The 2026 guidance targets 475,000 to 525,000 ounces of gold production, with an average recovery of 91%. More importantly for LunR, the operator is investing $85 million in an exploration campaign, the largest in FDN's history, targeting 133,000 meters of drilling. This includes the FDN South (FDNS) deposit, where an investment decision on development is expected in H1 2026, and the FDN East discovery. Any expansion of the resource base or mill capacity, currently being evaluated for expansion beyond 5,500 TPD, directly accrues to LunR's long-term revenue without any requirement for capital contribution. As of December 31, 2025, Fruta del Norte reported robust mineral reserves and resources, Total proven and probable (PNP) reserves stand at 25.7 million tons, grading 7.09 grams per T gold and 10.77 grams per T silver, containing approximately 5.85 million ounces of gold and 8.9 million ounces of silver. Measured and indicated M&I resources, which are inclusive of reserves, total 32.6 million tons at 7.13 grams per T gold and 11.18 grams per T silver, representing 7.48 million ounces of gold and 11.7 million ounces of silver.
The Vicuña District, high-leverage exploration assets. While the Fruta del Norte stream provides the foundational cash flow, LunR's blue sky potential is concentrated in the Vicuña District, an emerging copper-gold-silver province situated along the border of Chile and Argentina. LunR holds strategic royalty interests in two of the district's primary assets, Lunahuasi and Los Helados. Lunahuasi, a world-class high-grade discovery. Lunahuasi, 100% owned by NGX Minerals, is currently the site of one of the most successful drill programs in the Andean region. The Phase 4 program, which commenced in October 2025 and is scheduled to conclude in May 2026, has consistently returned intercepts that suggest a high-grade, large-scale system. The discovery has expanded to dimensions of at least 1,100 meters by 1,200 meters by 1,200 meters and remains open in all directions. For LunR, the 1.00% NSR royalty represents a high-margin interest in a deposit that is rapidly moving toward a maiden resource estimate. In March 2026, NGX received environmental approval for an exploration adit at Lunahuasi, a critical step toward underground development expected to begin in Q4 2026. Los Helados and the Vicuña Integrated Technical Study. Los Helados, in which LunR holds a 1.38% NSR royalty, is a massive copper-gold porphyry located in Chile. The asset is part of the broader Vicuña District strategy, which reached a milestone in February 2026 with the release of the Vicuña Integrated Technical Study, PEA, by London Mining and BHP. The PEA envisions a multi-stage development of the district. Stage 1 focuses on the Jose Maria deposit with a 175,000 TPD sulfide mill targeting $7.1 billion in initial capital. Stage 2 involves the development of oxide ores at Filo del Sol via heap leach and SXEW. Stage 3 anticipates the expansion of the concentrator to 293,000 TPD and maturation of the Filo del Sol sulfide deposit. Over a 70-year mine life, the integrated complex is projected to produce 400,000 tons of copper, 700,000 ounces of gold, and 22 million ounces of silver annually. While LunR's royalties are currently outside the core PEA deposits, the development of major district infrastructure, such as the new 220 kV high-voltage line and site access roads, significantly de-risks the future economics of Los Helados and Lunahuasi.
Macroeconomic and jurisdictional framework. The viability of LunR's royalty portfolio is intrinsically linked to the regulatory environments of Ecuador, Argentina, and Chile. The first quarter of 2026 has been marked by significant legislative shifts in these jurisdictions, largely trending toward pro-mining liberalization. Ecuador, regulatory reform and operational security. Ecuador's National Assembly approved a comprehensive mining reform package in February 2026, which entered into force on March 2, 2026. This reform represents the most significant overhaul of the mining code since 2009 and is designed to attract international capital by streamlining the permitting process. Key elements include the reduction of environmental authorization timelines from 24-36 months to 12 to 18 months through a single window process, and the creation of risk-based 3-tier licensing. Additionally, the reform establishes strategic security protection areas for mining to combat illegal activity and introduces a variable royalty scale of 3 to 8%. For LunR, these reforms enhance the predictability of the Fruta del Norte operation and accelerate the timeline for new discoveries in the surrounding porphyry corridor to reach production.
Argentina, the Milei administration and glacier law reform. In Argentina, the administration of President Javier Milei has pursued reforms to attract large-scale mining investment, particularly in the San Juan province. On April 9, 2026, the Argentine Chamber of Deputies approved a landmark reform to the National Glacier Law. The reform redefines protected areas, ensuring only ice bodies with a proven hydrological function retain federal protection, while transferring the power to define inventory areas to provincial governments. Furthermore, the Régimen de Incentivo a las Grandes Inversiones, RIGI, provides tax and legal incentives for investments over $200 million. For LunR, these changes dramatically lower the barrier to development for the Lunahuasi and Los Helados projects. The bull case for LunR royalties is predicated on the convergence of Tier 1 cash flow, unrivaled exploration optionality, and a uniquely advantageous corporate structure within a favorable commodity cycle. 1. Immediate Tier 1 cash flow and financial scalability. The acquisition of the FDN silver stream transforms LunR from a speculative royalty vehicle into a cash-flowing intermediate streaming company overnight. Upon closing, LunR is expected to become the sixth largest precious metals royalty and streaming company globally by market capitalization and revenue profile. This provides organic capital for future acquisitions, institutional re-rating, and long-term dividend capacity. 2. Unparalleled exploration leverage in the Vicuña camp. LunR offers investors a unique free ride on major exploration successes. The 1.00% NSR on Lunahuasi provides exposure to high-grade intercepts without the burden of contributing to billions in development capital. This model offers immunity from capital expenditure inflation while allowing for margin expansion as commodity prices rise. 3. Strategic alignment and the London ecosystem premium. The London premium refers to the higher multiples at which group-affiliated companies often trade due to management quality. LunR's position as the dedicated royalty vehicle ensures priority access to future streams generated by the group. Furthermore, the expected greater than 10% ownership by Newmont Corporation adds institutional credibility and potential global deal flow. The bear case. An examination of the company's current market positioning, its valuation relative to its peers, and the structural implications of its recent multi-million-dollar acquisition of a silver stream from the Fruta del Norte mine reveals a series of risks that form a bear case. The intersection of extreme valuation multiples, a massive impending share supply overhang, and the inherent geopolitical and technical hurdles of its primary assets suggests that the current share price reflects a level of optimism that ignores fundamental market mechanics and jurisdictional volatility. The most immediate concern for evaluating LunR royalties is the disconnect between the company's market capitalization and its underlying financial fundamentals. As of April 2026, LunR trades at a price-to-book (PB) ratio that fluctuates between 470x and 500x, a figure that is not merely high but is historically anomalous for the mining royalty sector. While senior royalty companies like Franco-Nevada typically command premiums due to their diversified, cash-flowing portfolios and decades of operational history, LunR is an emerging entity with a narrow asset base and, until very recently, zero revenue. The market capitalization, which has hovered around the CAD 1.79 billion to CAD 2.1 billion mark, is predicated on the future value of assets that are currently in the exploration or pre-development stages, or in the case of the FDN stream, a byproduct stream that has yet to deliver its first ounce to the company. The company's income statement for the period ending December 30, 2025, underscores the speculative nature of its current valuation. LunR reported a net loss of CAD 1.31 million, with no revenue generated during the fiscal year. While the royalty model is designed to be lean, with zero reported employees and minimal overhead, the lack of current cash flow forces the market to rely entirely on net asset value, NAV, projections, and future production estimates. The London premium is clearly at play here, where investors are willing to pay an astronomical multiple for the pedigree of the management team and the group's history of world-class discoveries. However, historically, such premiums tend to contract when the reality of long lead-time mining projects begins to set in, or when significant share supply enters the market, both of which are imminent catalysts for LunR. Furthermore, the enterprise value to sales or enterprise value to EBITDA metrics are currently uncalculable, leaving investors with only the PB ratio as a measure of relative value. When compared to other intermediate royalty companies or even high-growth junior miners, a 500x book multiple suggests that even a minor delay in project timelines or a slight softening in commodity prices could lead to a catastrophic re-rating of the stock. The Fruta del Norte silver stream, structural dilution and concentration risk. The acquisition of a life-of-mine (LOM) silver stream on the Fruta del Norte mine in Ecuador for approximately $670 million was presented as a transformational event for LunR. While this transaction does provide the company with its first meaningful cash flow, the terms of the deal and the method of payment introduce several bearish factors that have yet to be fully integrated into the market's risk assessment. The deal is structured as a stream for equity transaction, meaning LunR is not utilizing cash, but is instead issuing 50,505,051 new common shares to Lundin Gold as consideration.
The tiered stream structure and diminishing returns. The silver stream is not a simple percentage of production. It is highly structured with significant drop-down thresholds that limit the long-term upside for LunR shareholders. The immediate cash flow is derived from the first 12.2 million ounces, but as the mine matures and production continues, LunR's interest significantly contracts. While the stream is uncapped, the eventual drop to 7.5% exposure means that LunR is essentially front-loading the value of the byproduct, while the operator, Lundin Gold, retains the vast majority of the asset's long-term precious metal optionality. Furthermore, silver at FDN is a minor byproduct, representing only 1 to 2% of the mine's total revenue. This makes the stream entirely dependent on the operational efficiency of the primary gold circuit. Any technical disruptions or geological challenges that affect gold production will have a direct and proportional impact on the silver deliveries, without silver-specific operational adjustments being a priority for the miner.
Concentration in a high-risk jurisdiction. By anchoring its near-term cash flow to an asset in Ecuador, LunR is concentrating its financial health in one of Latin America's more volatile mining jurisdictions. While Fruta del Norte is a Tier 1 operation, Ecuador has seen shifts in its political climate that have historically threatened mining stability through social protests and regulatory uncertainty. The fact that LunR's first cash-flowing asset is a byproduct stream in a single mine jurisdiction creates a single point of failure risk for the company's valuation. If FDN were to experience an extended shutdown or a change in its fiscal regime, LunR's ability to fund its own operations or participate in future M&A would be severely compromised, as it currently lacks the diversified cash flows of established peers.
The impending share supply overhang, the dividend-in-kind threat. Perhaps the most critical bearish catalyst for LunR is the mechanism by which the 50.5 million new shares are being brought into the market. Lundin Gold has clearly stated that it does not intend to hold these shares. Rather, it will distribute them as a dividend-in-kind to its existing shareholders upon the closing of the transaction in Q2 2026. This creates an unprecedented supply overhang for a junior-listed stock on the TSX Venture Exchange. Lundin Gold is a major precious metals producer with a diversified global institutional shareholder base. Many of these institutional investors, particularly those with mandates focused on large-cap, cash-flowing gold producers, may be restricted from holding shares in a junior venture-listed royalty company. When these funds receive LunR shares as a dividend, they are effectively forced to sell them, regardless of their long-term outlook for the company.
The issuance of 50.5 million shares against an existing base of approximately 70.4 million represents a massive 72% increase in the share count. The market is now faced with absorbing nearly 42% of the company's pro forma equity into the hands of shareholders who did not seek out this exposure and may have immediate liquidity needs or portfolio constraints. The distribution process also excludes certain jurisdictions, such as the United States, where the dividend-in-kind would be restricted by securities laws. In these cases, the shares will be sold on behalf of the shareholders, adding further immediate downward pressure on the stock price as these blocks are liquidated into the open market. The 20-day VWAP used to price the transaction was CAD 18.18, significantly lower than the current trading price. As the closing date in Q2 2026 approaches, the stock is likely to gravitate toward this lower valuation as the reality of the supply dump becomes clear to retail investors.
Vicuña District, the multi-billion-dollar development hurdle.
The core of LunR's long-term optionality lies in its royalties on the Los Salados 1.38% NSR and Lunahuasi 1% NSR projects in the Vicuña district. While these projects are undeniably of massive scale, the bear case rests on the immense technical and economic hurdles required to bring them into production. The Vicuña Integrated Technical Study, released in February 2026, outlines an integrated development plan that requires a staggered investment of $18.1 billion across 3 stages. Bringing a massive copper-gold porphyry system into production in the high Andes is one of the most capital-intensive endeavors in the mining industry. The initial capital requirement for Stage 1 alone is estimated at $7.1 billion, focusing on the Josemaria deposit. For LunR's royalties on Los Salados and Lunahuasi to generate cash flow, the operator, likely a joint venture between London Mining and BHP, must first commit to and fund this monumental capex program. In an environment of persistent global inflation and elevated interest rates, the cost of labor, specialized mining equipment, and energy in remote mountain regions is under constant upward pressure. Furthermore, the logistics of the district are daunting. The proposed solution involves trucking concentrates hundreds of kilometers to Chilean ports, a supply chain that is vulnerable to blockades, labor strikes, and extreme weather events. The requirement for a dedicated roasting plant to process high arsenic concentrates at Fila del Sol also adds significant metallurgical and environmental risk, which could delay permits or increase the already staggering cost estimates.
Timeline to production, the time value of money. For a royalty holder, the time value of money is a critical component of the asset's net present value, NPV. The Vicuña projects are envisioned to operate over a 70-year mine life, but the timeline for first production from the deposits where LunR holds royalties is still years away. Stage 1 only targets the Josemaria deposit. Subsequent stages to incorporate Filo del Sol and potentially Los Salados are subject to the successful execution and cash flow generation of the earlier stages. If the start of production at Los Salados is delayed by even 5 years beyond the current speculative timelines, the NPV of that royalty for LunR collapses when discounted at the standard 8% to 10% rates used for Latin American mining projects. Investors currently paying a massive premium for LunR are essentially discounting production that may not occur until the 2030s, ignoring the high probability of marooned assets in a capital-constrained environment.
Jurisdictional risks: Argentina, Chile, and the Latin American mining landscape. LunR's portfolio is entirely concentrated in South America, with a specific focus on the San Juan province of Argentina and the Atacama region of Chile. Both countries present distinct but significant sovereign risks that could impair the value of the company's royalties. While San Juan is often cited as a mining-friendly enclave within Argentina, the country's federal economic situation is characterized by hyperinflation, severe currency controls, and a history of sovereign defaults. For a large-scale project like Lunahuasi or the integrated Josemaria district, the inability to freely repatriate capital or the requirement to convert export revenues at unfavorable official exchange rates can destroy the economic viability of the mine. If the operator cannot guarantee a return on its US $18 billion investment due to federal policy shifts, the project will be shelved, leaving LunR with a non-performing asset in a hostile economic environment.
Chile's evolving regulatory environment. Chile has historically been the bedrock of global copper production, but in recent years it has faced a period of intense social and political debate over the distribution of mining wealth. While the most radical constitutional proposals were rejected, the trend toward increased royalties and environmental regulations is unmistakable. Any increase in the government's take at the mine level, even if it does not directly tax the NSR royalty holder, reduces the operator's free cash flow and its incentive to aggressively expand and develop the resource, which is the primary driver of value for a royalty company. The related party and conflict of interest concerns. The corporate structure of the London Group, while successful, creates complex webs of ownership and influence that can lead to perceived or actual conflicts of interest. The FDN transaction is a primary example. LunR is acquiring an asset from London Gold, another member of the group, and paying for it with shares that will then be distributed back to the group's wider investor base.
Board independence and governance. At various points, analysts have noted that LunR had no independent directors or was heavily influenced by its parent, NGX Minerals, which still retains a 19.9% interest in the company. While a special committee of independent directors was formed for the FDN deal, the non-arm's length nature of the company's deal flow is a persistent risk. Minorities in LunR are essentially trusting the London family's internal capital allocation decisions. If the family decides to prioritize the success of a larger entity, like London Gold or London Mining, at the expense of LunR, the minority shareholders have limited recourse. The appointment of a representative from Newmont Corporation to the LunR board following the FDN deal is a notable development, but it also highlights that LunR is becoming a satellite entity for much larger corporate interests. Newmont, as a 32% owner of London Gold, will become a significant shareholder in LunR. While this adds big mining credibility, it also increases the risk that LunR is used as a strategic tool for the majors, rather than a vehicle focused solely on maximizing returns for its own public shareholders.
OTC market warnings and unsolicited quotes. In the United States, the company trades on the OTC pink sheets under the symbol LNRCF. This security has been flagged with warnings as eligible for unsolicited quotes only, meaning it is not eligible for proprietary broker-dealer quotations and reflects only unsolicited customer orders. For U.S.-based investors, this creates a significant liquidity risk. The lack of a continuous market-making presence means that selling a large block of shares could lead to a rapid collapse in the price. This lack of institutional-grade trading infrastructure in the U.S. further emphasizes the speculative nature of the current rally.
Conclusion. The bull case for LunR Royalties is that it is an expertly managed vehicle that allows investors to capitalize on the London Group's district-scale successes while enjoying the risk mitigation benefits of the royalty business model. The quality of the underlying assets and the strength of the strategic partnerships position LunR for potential outperformance. The case for avoiding LunR royalties at current levels is not based on the lack of quality in its underlying assets, but on the unsustainable price the market is paying for them and the structural catalysts that are likely to drive that price lower. The company is currently a perfect storm of bearish indicators: an extreme valuation multiple, 500x PB, a massive and impending dilution event, 72% share increase, and a concentration of risk in byproduct streams and high capex Andes projects that are a decade away from full maturity. The Dividend-in-Kind distribution from London Gold in Q2 2026 is the most immediate and dangerous catalyst. The market is effectively being asked to absorb 50.5 million shares from holders who have no natural affinity for junior venture stocks, combined with the jurisdictional instability of Argentina and the technical challenges of an $18 billion district development. Until the company demonstrates a diversified, stable cash flow and survives the impending share supply shock, its current valuation remains unsupported by the reality of the mining industry's economic cycles.